Welcome to your personalized deep dive.
Oh, I like that.
Today we're going to be talking about numbers, cracking open the Economist Numbers guide.
Okay.
To uncover those tools and concepts for working with them, especially in business, I've always felt like there's a certain elegance to numbers, you know?
Uh-huh.
They seem so precise, so absolute.
It's true. Numbers can be very satisfying. They offer that sense of certainty.
Yeah.
But the real magic is knowing how to use them. Like tools for making decisions and analysis, we'll be exploring some really deceptively simple things like fractions and percentages.
Right.
But those are actually vital for handling financial issues.
Yeah.
And of course, we're going to unlock the secrets of compound interest,
Ooh.
that force that can really make a difference in your financial decisions.
You know, it's funny. Did you know that the decimal system that we use every day likely came from just counting on our fingers?
It's amazing how something so basic has shaped our entire understanding of numbers,
Yeah.
and it reminds us that number systems are human inventions.
Yeah.
Other cultures develop different systems, like the base 12 duodecimal system,
Oh, yeah.
which we see traces of in units like inches, and even the old British currency.
Yeah, 12 pennies to a shilling.
Exactly.
Fascinating how those systems reflect our history and the way we think about things. But getting back to that practical side, I'm curious about how mastering these fractions, percentages, proportions, all of that can help someone make those smarter financial decisions.
It's all about understanding the relationships between those numbers.
Yeah.
Say, if you're looking at investment returns, knowing how to calculate percentages can really help you compare different options,
Right.
even if they have different time frames or initial investments.
So you can really see, instead of just seeing a jumble of numbers,
Yeah,
you can really understand what they mean in a real-world context.
precisely. And that leads us very nicely into the world of finance. One common challenge is comparing investments that have different returns over different periods. It's like comparing apples and oranges.
Oh, yeah.
How do you do that?
So that's where simple interest and compound interest come in, right? I remember those terms, but could you just refresh my memory?
Of course. Simple interest is pretty straightforward. It's a fixed percentage calculated only on the original amount, the principal.
Right.
But compound interest is where things get really interesting. That's where it's calculated on the principal plus any accumulated interest. So your money essentially starts earning interest on the interest it's already earned.
Like a snowball effect.
Exactly. It keeps getting bigger and bigger over time.
Do you have any good examples of how this plays out in the real world?
Oh, absolutely. The Economist Numbers Guide actually gives a perfect example in Table 2.1. Imagine you have an investment account. It has a 10% annual interest rate.
Okay.
Compounding annually yields a certain return, but imagine compounding that same 10% rate quarterly
Okay.
or even monthly. The more frequently interest is compounded, the greater the return you get over time.
So even a small difference in that compounding frequency can lead to some really big differences in the long run.
Exactly. It just highlights the power of understanding these seemingly subtle nuances in finance. It's not just about the interest rate itself, it's about how and when it's applied.
Like a little hidden lever that can dramatically amplify your returns.
Exactly.
Wow. I'm really starting to see why mastering these financial concepts is so important.
Yeah.
And speaking of levers, what about annuities? I always thought those were just for retirement.
Well, while annuities are very commonly associated with retirement planning, their applications are much broader than that. An annuity is essentially a series of regular payments made at equal time intervals. Think of it like a stream of income.
Oh, okay.
Mortgage payments are a great example of this.
Oh, interesting.
You're making regular payments over a set period.
So if I'm paying off my mortgage, I'm actually dealing with an annuity.
Precisely.
Wow.
And understanding that math behind annuities can help you make more informed decisions about, say, your repayment plan and the total cost of your loan.
Okay, that makes sense. Now, what about these perpetual annuities? They sound a bit like something out of a science fiction novel.
They do sound a bit futuristic, don't they?
Yeah.
But perpetual annuities do exist.
Right.
They're annuities that go on forever.
Oh, wow.
A good example is a government bond that never matures.
Okay.
The interest payments on that bond continue indefinitely.
So the key to managing those annuities, both the finite and the perpetual ones, is really understanding that relationship between the regular payment, the interest rate, and then the present value or future value of that annuity.
Exactly. And the book actually provides all the formulas and tools to calculate those values so you can make those more informed decisions. But of course, we can't forget about the silent force that affects all financial calculations.
Inflation.
Inflation, exactly.
It's like hidden tax. It just chips away at your purchasing power over time.
It really is. Another form of interest, but working in reverse.
Exactly. Does the book have any tips for dealing with that?
Absolutely. The Economist Numbers Guide explains how to factor in inflation when you're making calculations. So you're getting a clearer picture of the real value of your money over time.
That's really helpful.
It also offers a really helpful trick for simplifying those exchange rate conversions.
Ooh.
Instead of getting bogged down in complex calculations, you can simply divide that exchange rate into one to swap the base currencies.
Okay.
So for instance, if you know the euro per dollar rate,
Right.
you can easily calculate the dollar per euro rate.
Wow, that's so helpful. Like a secret decoder ring for the world of finance.
That's a great way to put it. Understanding these tools really can empower you, make smarter decisions, and navigate those often very complex waters of money.
Yeah, it makes it so much less intimidating.
Much less.
And I'm starting to see how powerful those seemingly basic concepts really can be.
Yes.
We've covered so much ground already, from the origins of those number systems to the intricacies of compound interest and annuities. What's next on this journey through the world of numbers?
Well, we've been talking about money, but numbers really have such a broader impact. Next, we're going to delve into data analysis, which can be surprisingly engaging once you have the right tools.
Oh, I like that. Can't wait. We've been talking about how understanding those building blocks of finance can really help us become more savvy decision makers. But let's move beyond just money into that wider world of data analysis. This is where things get really exciting for me. Data is just everywhere these days.
You're absolutely right. Data is constantly shaping our world, from the news we read to the products we buy. And the Economist Numbers Guide really gives us the tools to make sense of it all.
Okay, I'm ready to unlock those tools. The book starts with averages. They seem pretty simple, but I feel
Yeah.
like there's got to be more to it than just adding up those numbers and dividing, right?
You're right to be suspicious. While averages are commonly used to kind of summarize data, there are actually different types of averages,
Oh.
each with its own strengths and weaknesses. So we've got the mean, the median, and the mode.
Okay. Those terms definitely ring a bell from like school days.
Yeah,
But could you maybe give me a little refresher?
of course. So the mean is what most people think of when they think of the average.
Okay.
You sum up all the values and then divide by the total number.
Right, right.
The median, however, represents that middle value when all of the data is arranged in order.
Okay.
And the mode is the value that appears most often in the data set.
So which average is the right one to use? Does it just depend?
It absolutely depends on the situation and what you're trying to understand. So for instance, the mean can be easily skewed by really extreme values.
Okay.
Imagine like 9 people who all earn around, say, $50,000 a year,
Okay.
and then one person who's earning like $1 million a year.
Wow.
That mean income would be pulled upwards by that outlier, giving a maybe misleading impression of what the typical income actually is.
Right.
So in this case, the median would actually give you a much more accurate picture.
That's a great example. And it reminds me of how real estate prices, can be impacted by those few really, really expensive homes.
Yes.
So the median price is probably a better indicator for most people.
Precisely. And understanding those different types of averages really helps us to see beyond potentially misleading numbers.
Yeah.
Now, another important concept in data analysis is the normal distribution. It's often depicted as that bell-shaped curve.
Ah, yes, the bell curve. I remember seeing those in textbooks.
Yeah.
But I'm a little fuzzy on how it's actually used in practice.
So the normal distribution is really powerful for understanding where data points lie within a distribution. It's used across many, many fields, from analyzing test scores to forecasting sales. And the key concept here is something called standard deviation,
Okay.
which measures how spread out the data is from that mean.
Okay. Is there like a real world example to help visualize that?
Absolutely. Let's say you're in the business of making those adorable teddy bears.
Yep.
And you want to ensure that they all have like a consistent weight, right?
Right.
Let's say the average weight is 2.2 kilograms
Mm-hmm.
and the standard deviation is 0.2 kilograms.
Okay.
This means that about 68% of your teddy bears will weigh between 1.8 and 2.2 kilograms, falling within one standard deviation from that mean.
Okay.
And about 95% will be between 1.6 and 2.4 kilograms within 2 standard deviations.
So the standard deviation basically tells me how much variation there is to expect. like a measure of consistency.
Exactly. It's like how much do things differ from that average?
Yeah.
And the normal distribution provides a really useful framework for understanding and quantifying that variation.
Okay.
But, numbers alone can sometimes be a bit dry,
Yeah.
which is why data visualization is so important.
Right, those charts and graphs.
Exactly.
Okay.
Charts and graphs can really make things come alive.
And the book mentions, different types of charts, like line graphs and pie charts and scatter plots. And I've always wondered, when to use which.
Each chart type has its own purpose. Line graphs are really good for showing trends over time,
Okay.
like how stock prices change or website traffic fluctuates.
Yeah.
Pie charts are great for visualizing those proportions of a whole,
So,
like how market share is divided among different companies.
right.
And then scatter plots are useful for exploring the relationship between two variables,
Okay.
like seeing if there's a correlation between advertising, spending, and sales.
Okay, so it's really about matching the chart type to what you're trying to show.
Precisely. But even with the right chart, presenting the data effectively can still be tricky.
Oh, yeah, absolutely.
So the Economist Numbers Guide emphasizes the importance of presenting data in tables using what they call the rule of three.
Okay, the rule of three, that sounds interesting. Tell me more.
It's a set of guidelines for making tables more effective.
Okay.
So first, keep them concise.
Okay.
Eliminate any unnecessary information,
Uh.
round numbers to 2 or 3 significant figures.
Right.
Second, make them informative. Include summary measures like totals and percentages.
Gotcha.
And finally, organize the information logically, often by order of importance or size.
So it's about clarity, relevance, and then structure.
Exactly. Now, what about index numbers?
Okay, index numbers. Are they kind of like those stock market indices I see on the news?
The concept is similar. Index numbers are used to track changes in a set of data over time.
Okay.
You set a base year value to 100, and then express all those subsequent values as a percentage of that base.
Okay.
They're helpful for comparing trends in different variables, even if they're measured in different units. But there's a potential pitfall to watch out for.
Oh, okay.
It's called the convergence illusion.
Convergence illusion. That sounds a bit ominous. What is that?
Well, it's the tendency for index numbers to appear to converge over time, even if the underlying data is not actually converging.
Okay.
And this happens because they're all anchored to that same base year value.
Got it.
The book is a great example of this in Figure 1.2. Imagine 2 lines on a graph. They're steadily diverging. Converting them to index numbers makes them initially move apart, but then they seemingly come closer together as time goes on, even though the actual gap between them is widening.
So we need to be cautious about misinterpreting them, especially when we're making comparisons over long periods.
Exactly. And that brings us to another powerful tool for analyzing those trends over time. Time series analysis.
Oh, okay. Time series analysis. Tell me more. Time series analysis. It sounds so complex.
I know, it does sound a bit intimidating.
But I'm guessing it's about, understanding those patterns and trends in data that we might not see just by looking at it.
You're exactly right.
Yep.
Time series analysis is all about uncovering those hidden patterns in data that changes over time. Businesses use this all the time to understand things like seasonal sales fluctuations, long-term growth trends, and all sorts of things.
Yeah, like trying to figure out if those holiday sales are actually, a real boost or if it's just part of a bigger pattern. And the book mentioned breaking down that time series into components like trend, cycle, and seasonal element. Can you kind of unpack those for me?
Sure. The trend is basically the overall direction of the data over a long period. Think of it as that general upward or downward movement. The cycle refers to those fluctuations around that trend, often influenced by things like economic conditions or business cycles. And then that seasonal element, as you mentioned, captures those recurring patterns that happen at specific times each year, like those holiday sales.
So by separating those components, we can kind of get a clearer picture of what's really driving the data and make better predictions. It's like filtering out the noise to see the signal.
Exactly. And there are several techniques for doing this. Moving averages, exponential smoothing. These are just 2 examples.
And moving averages, those involve calculating the average over a set number of data points, right?
That's right. It's like smoothing out the bumps in a line.
Okay, yeah.
By moving that window along that time series, you can filter out those short-term fluctuations and get a better sense of the underlying trend. Exponential smoothing is similar, but it gives more weight to more recent data, making it kind of more responsive to changes in the trend.
So if there is a strong seasonal element, like we were talking about with those holiday sales, we need to adjust for that so we're not making, bad comparisons.
Absolutely. We don't want to be celebrating a sales boom that's really just the usual holiday rush. The book explains how to identify and remove those seasonal patterns so that you can really focus on the underlying trends and make meaningful comparisons between different periods.
Right, really see what's going on.
But it's important to remember that even after you've accounted for those trends, cycles, and seasons, there's always a little bit of randomness,
Yeah.
a residual element, some things we just can't fully explain.
Yeah, the unpredictable quirks of the world. But even if we can't predict everything, understanding those other components gives us a much better handle on things. Now, the book also talks about forecasting techniques, like those leading indicators. What are those all about?
So leading indicators are basically variables that tend to change before the variable that we're actually trying to forecast
Hmm.
and give us that early warning system. For example, changes in consumer confidence might be a leading indicator for future retail sales.
Okay.
If people are feeling optimistic, they're more likely to spend.
Oh, so it's like looking at the canary in the coal mine, almost.
Exactly. You're observing something to help predict something else.
Okay.
Then there's regression analysis, which is a bit more of a statistical approach.
Okay.
It helps identify the relationship between variables
Okay.
and then use that relationship to make predictions about the future. So let's say a company wants to understand how their advertising spending affects their sales. Regression analysis can help quantify that relationship and predict future sales based on their planned advertising campaigns.
So it's really a powerful tool for planning and making those decisions. But, the book also emphasizes that those forecasts aren't set in stone, right?
Of course not. They're not crystal balls.
Yeah, exactly. We need to be monitoring them and kind of adapting as new information comes in.
Exactly. Forecasts are based on data and assumptions that can change. So it's super important to regularly review and update them to make sure they're still relevant and accurate. But even with the best forecasts, we often face decisions with uncertain outcomes.
Right.
That's where decision analysis comes in.
Oh, okay. Making choices when you don't know exactly what's going to happen.
Yes.
That sounds very real world to me.
It's a framework for navigating that uncertainty.
Okay.
We identify all those possible decisions, all the potential outcomes, and the probabilities of each of those outcomes occurring.
Well,
Often, it involves weighing those potential benefits against the risks associated with each choice.
right. The book mentioned like decision tables and decision trees.
Yes,
Are those kind of like visual aids to help untangle all that?
absolutely.
Yeah.
So, decision tables lay out all those possible decisions and outcomes, along with the associated payoffs.
Okay.
And decision trees are a bit more visual. They show the decisions and outcomes as branches of a tree, kind of like mapping out a choose-your-own-adventure story, to see those potential paths and how likely they are to occur.
Ooh, I like that analogy. That makes a lot of sense. And then there's the concept of utility, which I found fascinating. It's not just about money, right?
Right? Utility is much broader than just money. It's about quantifying the value that we place on different outcomes, including our preferences and how much risk we're comfortable taking.
Right.
So, for example, a risk-averse person might choose a lower potential reward, but with a higher chance of success, whereas a risk taker might go for that really high reward even if the odds are stacked against them.
So it's like factoring in your own personality, your goals into the equation. It's so much more nuanced than just crunching numbers.
Exactly. It adds that human element to it.
Yeah.
And speaking of making strategic decisions, we can't forget game theory.
Oh, yes. Game theory. It's always sounded so intimidating, but now I'm actually really curious.
It's really not as intimidating as it sounds. It analyzes strategic interactions where you have multiple players all trying to maximize their own gains. Think of it like a game of chess.
Oh, okay. Are there some real-world examples of game theory in action?
Oh, so many. From economics and political science to everyday life, it's used in so many areas. Businesses use it to understand competitive pricing strategies, negotiation tactics. The Economist Numbers guide even gives this great example of two competing clothing companies battling it out for market share.
Wow.
It's all about anticipating what your opponent's moves are going to be,
Yeah.
and then making the best choices for yourself based on what you think they're going to do.
So strategic thinking. Okay. And then we've got queuing theory. And I know it's not just about managing lines at the grocery store.
Right. Although those lines can be very frustrating, can't they?
Yes, they can.
Queuing theory has applications in telecommunications, transportation, computer science, and so many other areas.
Okay.
It helps optimize those systems to minimize wait times and maximize efficiency. Think of it as finding the best way to keep things flowing smoothly.
Makes sense. And then stock control. Is that about managing inventory?
It is. It's about managing inventory efficiently.
Okay.
Stock control uses similar principles to queuing theory. It's about finding that sweet spot. You need to meet demand, but you don't want to have too much inventory.
Okay.
So it's about finding that balance.
Yeah, that makes a lot of sense. Okay, last but not least, the book briefly mentioned these things called Markov chains. What are those?
So Markov chains are used to model systems that transition between different states over time. The key idea is that the future state only depends on the present state, not the past.
Oh, okay, so like what happens next is only determined by where we are now, not how we got here.
Precisely. It's a really powerful tool for predicting future behavior. And it's used to model things like customer behavior, financial markets, even weather patterns.
Wow. We have journeyed through the world of numbers today, from those basic calculations to forecasting, decision-making, strategic thinking, even a little bit of philosophy in there. It's amazing how these concepts can be applied to so many aspects of our lives.
It's been a truly fascinating exploration, and the Economist Numbers Guide really provides a fantastic toolkit for anyone who wants to understand and navigate this world.
So what does this all mean for you, our listener? It means that understanding numbers is not just about being good at math. It's about empowering yourself to make better decisions and see the world in a new light.
We've seen how these concepts play out in business, finance, data analysis, but they really do have much wider applications. Think about how probability or game theory, even decision analysis, might apply to your personal life, your relationships, maybe even your hobbies.
Yeah, it's like having a new lens to view the world and make sense of things. So keep exploring, keep questioning, and keep diving deep. Who knows what you might discover out there in that world of numbers?